Okay, so you should probably have a pretty good understanding of what makes a company look good for a capital raise, no? What can you do to make yourself more appealing?
Having a business case and a business plan that makes sense.
Yep.
If it's too complicated, or if you're sort of a lot of founders are great at selling their product to clients, but not great at selling their business to investors. So it's stripping that back to bare bones and working out what is the problem you're trying to solve. Why do you exist? How are you solving that problem? Why are you better than everyone else at doing it? How are you going to achieve it?
Yep.
So,
and would you have all that in the pitch deck?
100%.
And so you've seen some great pitch decks and some crappy ones?
Yeah, definitely. And that's part of our job on a crowdfunding raise or a wholesale raise, is helping the company distill that information into a 20-page pitch deck that talks about the problem, the solution, how these guys are going to deliver on it.
Oh, so you actually help them do that too.
Yes.
So even if they come to you with one, you can help them improve it to get it to the investors.
And look, whether you're raising money for a multi-billion-dollar company or multi-million-dollar company, it doesn't really matter. It's the same story. Yeah. It's about the investment highlights. What is it that really sells?
What are some of the things that are a big no-no you should not do? If you're trying to raise capital, do not do this.
Don't bullshit. Obviously, legally you can't bullshit in a presentation or an offer document or a prospectus. Be honest about the plans and where you're going to go, because you can get found out pretty quickly. Well, the other thing as well in an investor meeting is be prepared. Because again, if someone asks you a question and you sort of go blank and you don't know the answer, it's not a great look as well for an investor that's looking to put in money into a company. I think being prepared, having a story lined up and going into a pitch, knowing what it is that what you're trying to achieve.
What are the things, what are the first things I have to do to actually prepare to raise for capital? I got taught to, even if you're not looking to sell or raise, always be ready to. So what are those things that you should always have in place?
Every growing business can always do with money. So always be ready to raise those funds. Having your story straight, having your investment case, investment thesis.
Your IM or?
Yeah, look, it's an IM, it's a presentation, it's a pitch deck. Know what you think you're worth. Have a good view on valuation. Always the most interesting part on raising funds of business is that the founder always think the business is worth X, the investors think it's worth half X, or the founders think it's worth 2X, and you sort of end up somewhere in the middle. And there's always a bit of argy-bargy there. Every founder thinks their business is worth multiples of what the investor thinks.
Well, what is the average multiple now, though? Because multiples are ridiculous. How can you tell what the multiple is supposed to be?
Yeah.
Now, how do you figure a multiple in your business? So it's a multiple of your profit? Is that correct?
The old school companies would generally trade on a PE, a price earnings multiple, which is what you're talking about. But now you've got businesses out there. One of the first big ones that did this was probably Amazon in the US. They were worth hundreds of billions of dollars, and they weren't even profitable. You can't price a business off an earning doesn't exist. Afterpay at the moment, they're worth $20 billion or so.
Is that how much?
And they're still not profitable. I suppose the other way of valuing a lot of these businesses is through discounted cash flow. So you look at the amount of cash flow the business is going to generate in the future. You effectively discount that back at a discount rate and make a valuation based on that. So you're actually valuing the future cash flows of a business to come up with a valuation.
And so you use the current earnings to forecast the projection and then work your way back.
That's right. That's why a lot of equity analysts and investment bankers will value a business. You'll use a few methods. You use your price earnings multiple, an earnings EBITDA multiple, revenue multiple, and a DCF, discounted cash flow valuation.
And so when a founder wants to try value their business, should they do all of them? Do they do some of them? How do they look at it?
Well, it's hard for a company to value on a price earnings multiple if they're not profitable.
Yeah. Let's say you are profitable. Would you do it on the multiple per profit?
Yes. If you're a steady state large business or growing business that's profitable, you'd price yourself on a price earnings multiple.
Yep.
A percentage
and how do you work out the multiple though? How do you know it's 5 times, 10 times?
Or 20 times? Yeah, you look at comps. You look at comparable businesses.
Okay, so you look at your industry, businesses that raise in certain space.
You do your DCF as well based on what your growth prospects are. So you could justify that. You might say, look, that company over there is trading at 10 times earnings, but I think I should be worth 15 times earnings because I'm growing faster.
And we have a bigger market share.
I've got a bigger market share, or I've got this other business line that I think is going to do really well. So look, valuation, it's a dark art.
And as long as you can justify your valuation, I guess that's the key. Okay, well, this is my valuation.
Yes.
This is how I got there.
Yep.
And this is why I believe we are valued at more than these people because of these A, B, C reasons.
Yeah, 100%. Again, and that goes to one of the key things you need to have ready when you are going to raise funds. Know what you're worth and be able to justify it. A lot of early stage businesses say, look, I think I'm worth $10 million because I've put $5 million worth of capital into it, and I think I deserve a 2 times multiple on what I've spent. Fair enough.
Okay.
That's
so you can
justified.
even go that simple.
Yeah. It might be pre-revenue, but they're on the edge of generating revenue, and if once they do hit the road, then they might generate large, significant amount of revenue, which would easily justify that valuation. We've raising north of $10, $15 million for these early stage businesses. All in all, in the Australian market, I think there's been about 80 successful raisings that have been 80 to 90 raisings in
With
equity crowdfunding. Yeah, so it's definitely become a viable avenue for early stage companies to raise capital.
That's really cool.
And it's growing year on year. So
and what's the benefit of an early stage business using crowdfunding as opposed to private investors?
Equity crowdfunding. What you're doing is bringing on the theory behind it was allowing early stage companies to raise capital, but also by dispersing the risk across a lot of people.
Mm-hmm.
So mums and dads putting in $500, $1,000, $5,000 into an early stage growth business. So it's lots of people coming together to fund a business and fund its growth.
So it does take a bit of pressure off,
Yeah.
Because if they lose the money, if I do screw it up, the company doesn't work out.
Yeah.
I haven't lost someone $200,000. I've lost someone $200.
Exactly. Or I've made them 10, 20 times their money.
Yeah. Or you could flip that the opposite way. Worry, oh shit, I've lost 1,000 people their money as opposed to one.
There's no doubt in that early stage investing is generally riskier. So look, the view is take a portfolio approach. Rather than putting $5,000 in one business, put $500 in 10 businesses.
Yeah, no, sorry, I was talking more from the
for the company side as well. As a
like me, the founder.
Yeah. But that's my point. If you're an investor, it's like, I've put money in 10 companies.
Yeah.
2 have gone belly up. 3 are doing okay. 5 have done really well.
Done well.
I've done okay.
Laughing.
And so look, so the benefit of a company doing equity crowdfunding to some extent is also bringing on shareholders who are then advocates.
That's very true.
So it's like you having all of your members as shareholders. And so not only they enjoy your product, but they're invested in the upside.
Yeah,
and so they're out there talking to everyone about, this is this business I've invested in, I'm a member, I love it. We've done the largest crowdfunding deal in the world by number of investors.
You have?
Yeah. We did that about a year and a half ago. So it was for a business called, it was in energy retailing called DC Power. And so they were basically targeting, their energy retailer targeting the 2 million households with solar panels on their roof. They felt like they're getting a raw deal from the existing energy retailers. So they wanted to get as many shareholders on board who they could then turn into clients or customers to sell them, solar-friendly
It's a really
energy.
genius strategy, no?
Yeah, so we worked with them in terms of tapping into databases of like-minded groups. Ended up getting 15,000 investors through that transaction and raised about $2.5 million.
They give you money and they also kind of become employees of the company because they could become clients in that sense. But for any company, let's say I raised capital, I got 1,000. I have a crowd of 1,000 raising the capital.
Yeah.
You have 1,000 people promoting the company the same way as a team member would.
Yeah, that's right.
But they gave you money.
So that was a good example. Another good example, we had a construction technology business. So not B2C like the energy retail business was, but B2B. So these guys had developed a way of building multi-story buildings a much faster and more efficient way using a steel backbone and structure. Quite a complex concept. But people got the construction industry needs to evolve and change. So for them, we raised about $800,000, got 400 or 500 investors on board for them. And the reason they did it is because they wanted to break into this sort of the smart young engineers and designers to change the way they think. And off the back of that crowdfunding raise, they got sort of 4 or 5 contracts to build new buildings around Australia.
Yeah.
So
it's almost like marketing and capital raising.
Yeah, that's what it is.